Alright, this short video will demonstrate some of the things you could have noted when you're comparing the common size balance sheet and income statement for Exxon and Chevron. And to tell you the truth, there are not a lot of differences between these two companies. These two are much more similar than the other three pairs of companies that we have. If we look up here in the common size balance sheet on the asset side, notice that the total current assets very similar for both companies, and note that it's been falling as a percent of total assets. Chevron tended to have more cash, Exxon less cash. Exxon had slightly higher accounts receivable, but those are really very, very close. If we look at the net property, plant, and equipment as a percent of total assets, very similar numbers between the two. Slightly higher for Exxon, but those are pretty similar. When we look at the other non-current assets, that's a fair large number. We see a little bit of goodwill for Chevron, and that the combined of these intangible type assets is slightly higher. I would suspect some of these non-current assets are like drilling rights and things like that, or oil field leases, things where they own the right to go drill something, an intangible asset. But I'd have to dig deeper into their 10K to find out for sure. But all in all, that's very, very, very similar balance sheets for these two companies. On the asset side. On the liability side, we see slightly higher current liabilities for Exxon, and probably that's almost identical with the accounts payable. They have slightly higher short-term debt. And the short-term debt's interest-bearing debt, and if you add it to the long-term debt, that's the things they pay interest on, that's not a lot of debt in between here and here, okay, if you're adding the two things with the title debt in them. And Chevron tends to have a little bit more of that over here. More of the long term, but they don't do as much of the short term. The total liabilities for Exxon are rock solid, right around 50%. It's only 40%, a little over 40% for Chevron. That means they use slightly more debt over here in Exxon, which makes them slightly riskier. Now, in terms of risk isn't necessarily a bad thing. It just, riskier is riskier. It also, as you'll discover when you start going through Chapter 4 of the text, higher risk means higher expected returns. Now, expected returns means the average, but it also increases the variability from year to year. If we look in here in the makeup of the equity, that's where the real big difference lies. Common stock and paid-in capital is funds that people have given to Exxon in exchange for shares. And as a percent of assets, really big over here, really small over here for Chevron. The retained earnings, they've retained a lot of earnings at Exxon over the years. But note these huge numbers in the treasury stock. That's where they bought back their own shares. And this other equity, and that's other equity adjustments. These negatives, when combined with these high positives, you still get to a total equity that's about 50% for Exxon, closer to 60% for Chevron. If we go down here and look in the income statement, these are virtually identical again. There's this, if you took the total over the years, slightly lower than over here in Chevron, but I call that rounding error. When we get down here, you see a big difference in the selling, general, and admin relative to Chevron. But in this line, I'm labeling depreciation expense, but it also includes other things. Slightly higher for Chevron. This could simply be a function of how the people at Morningstar aggregate data. So bottom line though, 22, 25, 22, 22, 15, 16, 13, 13. Chevron on an operating basis makes higher operating income. Now, when you get to this other income and expense, it's an expense when it's a negative outflow. Those are basically zero for Exxon, but you see they're positive numbers and can be very large. They're negative numbers and can be high in absolute value terms, like a big negative 10% here. That's a lot higher than their SG&A number. So bottom line, when you get to the net down here, the Chevron net income is slightly higher, but it also appears to be more variable. This is fairly rock solid relative to the movement we see over there in the Chevron.